And like on the built for rent side, like it used to be we can sell a built for rent project that didn't have homes being completed for 18 to 24 months via forward contract. Now that's kind of shifted where buyers are saying, hey, we want you to send us portfolios of the last 20 or 30 properties in a subdivision because we feel like we can get better value there. Or we want homes that'll be delivered before the first of next year because we don't know what the interest rate environment is going to be after the first month of next year. So like it's not only where pricing is today and what inventory looks like, it's also like what buyers think would happen or might happen. And they're trying to focus on things that are seemingly better opportunities today, so they can like not go on a fishing expedition in getting under contract with things that might not look like a great deal tomorrow.
Yeah, and it's so tough to kind of forecast cost of capital now.
Yeah.
So they only want to put things under contract where they can probably close this year.
Yep.
Or if they are willing to take on a little more risk, I don't know, maybe 12 months out tops.
Yes.
Whereas we've had opportunities from a developer where it's pretty much raw land now, and we were able to get forward contracts 18, 24 months out.
It's funny, like we went to a conference recently and people talked a lot about getting back to fundamentals. Like with build for rent, pricing got so wacky for a little bit that people forgot about the fundamental truth, which is when you buy raw land, you put a certain amount of money into that raw land to get it to be fully approved entitled lots. And like there's a profit margin there that got way out of whack because people were paying extraordinary prices for the end products. And they were willing to pay up for the land. And that kind of got builders to the point where we saw more deals that were like land deals where they were offering the land at an inflated price where like they were making hundreds of percent, maybe thousands of percent on their investment in the land just because they know they can sell the finished homes at the end of the day for a much lower cap rate. Now it's like getting back to fundamentals. Price of the land has to be appropriate. The costs that are coming up with to develop that land have to be really, really dialed in. And the finished lot cost has to make a lot of sense as a percentage of the home value at the end of the day. So when you look at all these things, this is kind of the way it always should have been, absent of this craziness that happened over the last 3 years. And a lot of sellers are now getting the picture that, oh geez, we got to start sharpening our pencils back to the way we used to do it in 2014, 2015 in order to make deals happen right now, because pricing these portfolios at higher than retail values into a cap rate that was, 5 months ago, 6 months ago, a year ago, isn't working anymore.
Yeah, and it's interesting because I believe we're having to adjust our underwriting because we, over the last 2 years, we've, for product that's being built 6 months, 12 months down the road, we're having to add in some sort of housing premium or pricing premium to what the finished units are going to be at that time. So underwriting has adjusted accordingly.
Yeah, and we're not doing that anymore. It used to be like we priced it to today's values, and we had to like forecast what the appreciation was so we can kind of try to price the properties that are going to be delivered in 12 months at tomorrow's value. Now the buyers just aren't willing to pay for it. Some of them are asking for a rebate because they don't know what's going to happen during that time. So like the house is worth $300,000 today, and like a year ago we might have thought it would be worth $320 in 12 months, right? Now it's like we're having a hard time selling it for $300 because the buyer's saying, hey, we don't know what's going to happen. We don't want to pay today's values. We want some kind of discount to today's values. And like that is a jarring change to any builder, like when they go down the retail route versus like looking at what institutional buyers will buy. It's going to take, I think, a quarter or two of really scary numbers on the home price front to have builders and build for rent suppliers really look at the number they can get from an institutional investor and think, is de-risking myself to the extent I can de-risk myself by selling to an institutional buyer really worth that kind of haircut? And I don't know that a lot of them will, but some of them might end up holding it and trying to go retail, and if they can't sell it retail, end up selling it for the discount that they're being offered today. Some of them might just say, hey, screw it. I can make good profit doing it today. I'll take the deal that's in front of me right now.
And I think to touch on the other side of the underwriting too, I spoke to a lot of buyers at our recent conference, and when the market was so hot, they were underwriting rents for their hold period, and they were adding, ridiculous premiums year after year, 10, 15, 20% rent growth in certain markets, which is obviously not going to be sustainable over a hold period. So they've had to dial back on their modeling, which has adjusted their offer prices. So it's really just, buyers sharpening their pencils on the underwriting, us having to, understand how they're underwriting to manage our seller expectations. So it's definitely been a learning process.